Well, our forecast for the next few years is more of the same. And I would say that is, I guess, looking back a year, a bit of a surprise. I guess a year ago we would have expected some sort of inflection point, either better or worse. And instead we're seeing really a continuation of what we've seen for the past few years. And overall, that's pretty good news in the sense that we don't have a slowdown. We would like to see something of an acceleration, but then again, we're really in sort of a coordinated lower for longer environment. That means lower growth and lower returns on the downside, but that also means lower interest rates and sort of fewer pressures that would really seem to disrupt things. So our outlook really for the next couple of years is really a continuation of what we've been seeing really over the last 12 or 18 months. I would say our forecast has changed over the last few months. About a year ago, we were really unclear about what our forecast would be. I would say that sometime right around the inauguration of this new administration, looking at what the equity market said, looking at what interest rates were doing, we started to upgrade our forecast, and that was based on the expectation of near-term growth that was a little stronger than we've seen. Then, really over the last 6 months, we haven't really seen those positive pressures build up, and so now we've adjusted again into that lower for longer forecast that we had really for the last few years, and we're really keeping with that until we see signs of either an acceleration or a deceleration. And we don't see signs of either at the moment. I mean, looking for pivot point of really what happens next, we're clearly further along in the cycle, so we're clearly closer to the end than the beginning. But how long it takes to get to that end is really uncertain. And what we're really looking for is clarity on that. So one pivot point could be some sort of sign of a drop in growth, and that's probably a risk that we haven't even identified yet, all the usual risks. Political uncertainty, labor availability. The economy and real estate markets have absorbed those pretty easily, and we would expect that to continue. But then there's more of an upside risk, and it is an upside risk because we don't necessarily expect it, but some real clarity around policy and really what's going to happen with taxes, regulations, trade, immigration. If we had any clarity on that, we would expect that may extend the cycle a little bit. I mean, having said that, there's nothing that's happened so far that suggests that that's likely to happen anytime soon. The interest rate outlook that we have, again, with a sort of a lower for longer, suggests to us that capital inflows should continue into real estate. We don't expect it to flood in, but at the same time, don't expect it to flood out either because there's more attractive opportunities available, say, in fixed income markets. So overall, that's more of the same. There's always been equity capital coming into real estate, and that continues across the risk-return spectrum, all the way from core real estate all the way up to value-added and opportunistic real estate. Speaking specifically about the U.S., the key change is that domestic capital's been a little more patient, a little net no flows into real estate, whereas foreign capital continues to come into U.S. real estate, and that foreign capital continues to come from Europe, but in particular from Asia recently. And we think that part of that response is because of the interest rate environment. One thing that has changed recently is the availability of capital in the debt markets. And that we have seen a change over the last 9 to 12 months, and there is definitely more capital available in the debt markets. That's true of the banks, which are the predominant source of debt lending, although that hasn't been a big change, but with a slightly lighter regulatory environment than they may have expected about a year ago. They continue to be active lenders within commercial real estate, particularly for stabilized or light value-add properties. Then you have the CMBS markets, which a year ago the outlook looked very uncertain, and we were expecting to see some liquidity challenges, particularly in the smaller markets or property types where CMBS lenders are more active. Instead, what we've seen is a turnaround in those markets and pretty strong investor demand. And so we've actually seen an increase in availability there. And then the third source of capital has been private debt funds. And many of these have been raised in the last few years and continue to take in capital. And that really plugs in the gap between the senior lenders and where the equity capital comes in. And that space is becoming pretty well served by those debt lenders. So overall, we have seen that increase in debt capital that's really causing transaction markets to hold up. All else being equal, it may prolong the cycle a little bit longer. The office market has not been as robust as we expected a few years ago, and we don't see that turning around anytime soon. Really, that's a function of continued but not particularly strong tenant demand, and the returns from office have been, I would say, disappointing relative to the underlying economic growth. The retail sector faces challenges that anybody who reads a paper is quite familiar with, although we think that there's sectors in the retail sector that have definitely been oversold on that basis. But then you look at the other side, the outlook for the apartment markets, where we've seen a considerable amount of new supply in many urban markets. We expect that supply to peak next year. So our outlook for the apartment markets, while again, keeping in mind that that's very challenged by that new supply, has actually increased or improved a little bit over the last 6 months. And then finally, for industrial markets, which is no secret at this point, that offers a very, very strong return outlook. We agree with that view, but also are mindful that the supply is picking up in that sector as well.